Broadcast is now starting. All attendees are in listen-only mode.
Hi, this is Nick Katko from BMA, and I'd like to welcome you to this week's webinar, this month's webinar, which is talking about standard costing and lean inventory valuation. Before we get started, I'd like to ask everyone who is attending live 3 simple questions, and you can respond in the question pane. I'm going to ask you verbally. There it is. Can you see me? Can you hear me? And can you see my screen? I do this because at the beginning of this webinar, I forgot to unmute myself. So I see that it appears like everything is okay, and I'll move on. That's good. A couple housekeeping items. If you look on the handout pane, handout section of your control panel, you'll see 2 handouts, which is a copy of the presentation and also a article I wrote for the Journal of Cost Management last year on this same topic, and they're both free for you to download. And the third housekeeping item is I usually do these webinars from the comfort of my home office, but I was asked to work at a client location today, so I am in a production facility. Conference space is quite limited, and you may hear some background noise, primarily a door opening and closing, and you might hear some muted voices, but this is the best I can do, so hopefully it won't be too disturbing. Okay, so let us get started. There's a copy of the handout screen to get things downloaded. So what are we going to learn about today? First, what does GAAP say about inventory valuation? Now, throughout this presentation, I'm going to use the acronym GAAP. I know that outside the U.S., it's called IFRS. Pretty much means the same thing, but for simplicity's sake, I'm going to use GAAP. So what does GAAP say about inventory valuation? I will explain how and why lean inventory valuation methodologies comply with GAAP. And I'm going to show you some examples and explain why they're beneficial to use. These are examples of companies that have used lean inventory valuation methods. And then how do you begin to have a discussion inside your organization about the transition to lean inventory valuation? So here's a few random thoughts, and a lot of this has to do with why I developed this presentation. I wrote the article, I've given this presentation at a few conferences, I've written a few blogs about it. One is the topic of standard costing in lean organizations today, even today, I think is still misunderstood. Primarily because different parts of the organization have different views about what standard costing is and what standard costing does. So one of the reasons I wanted to do this webinar was to try to create a little bit of common thinking about standard costing. And then when you hear the phrase eliminating standard costing or turn standard costing off, there's a lot of confusion and misinterpretation about what that means. and I hope to clarify that today. We have functional views versus organizational views about standard costing. The information that comes out of a standard costing system is used in many parts of the organization for different purposes. And I think it's important to get an organizational view, like almost like strategic, about what standard costing is, what standard costing does, and what can be done to improve it and or eliminate it. And lastly, think of this as a process, and there must be a plan. Much like everything else with lean, when you adopt a lean strategy, things change. Everything gets looked at and changed and improved throughout the organization. And that includes if you are an organization that uses a standard costing system, you and if you have a lean strategy, you are going to be faced with some issues related to standard costing and the lean strategy. So it's not short term. You don't have to worry about this next week or next month, but it's important to have a good discussion from a long-term view about what are we going to do. So let's talk about the GAAP principles. About what does GAAP say about inventory valuation and cost of goods sold? I really did what I would call a geeky thing a few years ago. Is I found the actual FASB standard and I read it because I wanted to just see exactly what does it say about inventory. And it's sort of interesting. I'm trying to summarize things here. So much like every other number on the balance sheet, inventory must be stated at cost. And so what the accounting pronouncement says is that it's the actual expenses incurred to get the goods in condition for sale. This includes how much you have to pay to buy the material that you use and produce, the production costs, and what's really, really interesting about what GAAP says, it involves many considerations. I don't know if you know anything about what GAAP says about it, or when the inventory valuation codification was created, but it was done a very, very long time ago. I think may have been in the 50s or the 60s. So even then, what's interesting is they recognized that this is a complex issue. It's not like buying an asset, a piece of machinery, and putting it on the balance sheet where you have an invoice and you know what the cost is. So there's complexity involved. The second part of the GAAP pronouncements relates to the matching principle and cost of goods sold. What are the proper expenses to recognize against the revenues that are being recognized? Now, the matching principle, we as CPAs and finance people, we understand it. It makes sense. We learned this back in our accounting education days. The problem is with manufacturing, it's a little more complex because there are difficulties in matching specific costs to the revenue recognized because of the continuous nature of manufacturing. What do we mean? Products are not sold necessarily in the same period as they are produced. Obviously, if an organization has a lot of finished goods inventory, it could be 60, 90, 120 days between the production of the finished goods and the actual sale. Prices change over time. Material prices change over time. And if you use any type of commodities in the production of your products, those prices can change on a daily basis. And lastly, production costs change over time. And this is not necessarily saying that labor costs increase, but You might have different people, different numbers of people on different production lines at any time. You run overtime. You might have temporaries. You bring in contract labor. You have a machine breakdown. You have to buy parts for that machine, or you have to call a supplier to come in to fix the machine. So these costs are constantly changing. They are not steady and stable, although we'd like them to be. So GAAP recognizes these difficulties of trying to get specific costs to a specific product. So what GAAP did is they created what they called cost flow assumptions. So these are methods in which to gather and report costs, value inventory, and report costs of goods sold. And I'm going to deal with these. I'll explain these assumptions in a second. But what's interesting is GAAP says that you must use a consistent method year to year. You can't just change every year. The method of cost flow assumption that you use must be disclosed in audit reports. And if you change it, it's a change in accounting principle. Now, this makes sense because if you're in finance and you've been involved in manufacturing over the years, you understand that there's advantages and disadvantages to each cost flow assumption in terms of what costs are recognized as cost of goods sold and how that impacts profitability. And you can't just change things year to year to maximize your profitability. So there are 4 codified cost flow assumptions in GAAP. One is FIFO, in which the most recent costs are assigned to inventory, ending inventory. LIFO is the opposite, where the most recent costs are assigned to cost of goods sold. Average cost is where inventory and cost of goods sold is stated at the average cost of all goods available for sale. And finally, there's the specific identification method, where the exact specific costs of a product can be accumulated and reported. That's rarely used in terms of most cost flow assumptions. So companies have to choose one of these. And what this does is this creates basically from a lean viewpoint, it creates standard work in which how to recognize your costs. So that's what GAAP says. So now let's talk about lean inventory valuation. What happens in a lean manufacturing organization? Inventories are reduced over time. This is because all the lean principles, practices, tools, and methods are designed to identify and eliminate waste over time. Inventory is considered waste, so it gets reduced over time. And it takes time to do this. Now, I was in a unique situation as a CFO in the 1990s when we embarked on a lean transformation. And in a relatively short period of time, 3 years, I'd say, we significantly reduced our inventories to the point where I think we went from like 3 or 4 turns to over about 24 turns. And we basically didn't have any finished goods inventory except what was sitting on the dock that was going to be shipped the next day. So I got to see this firsthand, how it works. And what I learned is that this is a tremendous opportunity in terms of creating a lean inventory valuation methodology to simplify a complex process. And that's really the way to think about this. So let's review lean inventory valuation in general as compared to GAAP. So when can you actually try to use different valuation methods? Typically, 30 to 60 days of inventory is a good target. So this is when. Now, before that, you might be able to get away with 90 days. But if you've got 6 months of inventory, this probably is not the time to start trying to figure this out. Why can you do this? I'm sorry. Why can you do this? One, from a materiality standpoint, the financial risk of misstating profits because of misstating inventory valuation is much, much less because you have less finished goods inventory and less WIP. The example I gave you about my experience, where the finished goods inventory at any point in time was what was going to be shipped the next day, that amounted in our business at the time to just less than $500,000 at any point. And given the fact that we were at the time, if I can remember, we were like a $40 million company, that the risk of misstating the amount of labor and overhead capitalized on $500,000 material was very, very small. So the idea is we want to maintain GAAP compliance. Maintaining GAAP compliance is a quality issue, if you think about it from a lean viewpoint. But we want to achieve GAAP compliance using the simplest, leanest method that we can do. So, what cost flow assumption do lean inventory valuations use? That is average cost, where inventory and cost of goods sold is at the average cost of all goods available for sale. This is not necessarily done at the individual product cost level. We try to, and especially for the labor and the overhead capitalization, which I'll show you some examples later. So for material portion, select the best method for your organization. And we're going to talk about that in a second. And for production costs, capitalize at the macro level rather than product by product. That's sort of the general framework, and you comply with GAAP in this way. And I'm just taking a little peek to make sure everything is working functionally here. So let's look at material cost. So when you're looking at the valuation of material, think about the equation price times quantity equals cost. And in terms of quantity, what method works best for you depends really on the amount of parts that you have in inventory. If you have few parts, it's quite simple to do a monthly physical inventory to understand the quantity, as opposed to tracking everything in systems. If you have many parts, it's probably best to keep the tracking of quantities in your system, whatever you use. The idea behind this in terms of quantity is what is the leanest way possible to maintain the quality of the quantities on hand. And even if you do track it in ERP systems, you want to try to minimize the number of transactions that have to be reported, because the more transactions, the more chance there is of error. On the price side, if you have few parts, you can use the average value stream. You can use the value stream average cost per unit or per day. So you have the quantity on hand and you have an average cost, and you simply multiply those two numbers together to get your inventory value. If you have many parts, you probably want to, and you're tracking them in ERP systems, you probably want to keep doing that. My recommendation is for each part, as opposed to using a standard cost, which changes maybe once a year, go to average cost or last price paid. And many ERP systems allow you to select either standard cost, average cost, or last price paid. I recommend using average cost or last price paid because the advantage there is it gives you your current value, and it begins to avoid this whole purchase price variance issue, which that's a whole separate topic of discussion. So what's the leanest, simplest way to calculate price times quantity equals cost? The fewer parts you have, the more you can sort of do it manually. And I've only been in a few companies over the years that can do this. They may only buy one or two raw materials and use it many, many ways. The majority of the companies, you have many SKUs. So the general recommendation is keep it in your system because that's the easiest way to do it. You don't want a complex system of lots of spreadsheets. Now, capitalization of production costs. This is the other piece of inventory valuation. And in my opinion, this is the tremendous opportunity that exists through lean inventory valuation methods because it has the potential to eliminate a lot of work. So with 30 to 60 days of inventory, your actual production costs are quite simple to gather and calculate, especially if you have a value stream income statement. 30 days of inventory, your value stream income statement, those actual production costs on the value stream income statement are accurate. You capitalize your production costs in total through a journal entry rather than product by product. This is the opportunity. And I'm going to show you some examples of how this is done. The requirements in your ERP system, you set your labor and overhead rates to 0. You want to get auditor buy-in on the methodology that you use. Now, as a CFO, I've done this a few times. And working at BMA and working with companies, I've helped many, many companies do this also. If you listen to or read anything about from the other lean accounting pioneers like Gene Cunningham, Ori Fumi, Jerry Solomon, they've done this also. And once you experience it, it works. And I've met people over the years recently at the Lean Accounting Summit who they might be controllers or CFOs that they've sort of done this also. And it's really interesting that, they were a lean company and they figured it out. And the work gets eliminated because you don't have to set labor rates and overhead rates every year. They're 0. Another benefit when labor and overhead rates are set to 0 is that many of your variances that get reported automatically through the standard costing system go away because if you have labor and overhead rates of 0, 0 times anything is 0, and they just disappear. Auditors are very open to simplifying the methodology. It's beneficial for them because they have less work to do. They don't have to study in a great detail especially if you have a product costing system. And even large international companies have been able to do this. The best example is Parker Hannifin, who we worked with a few years ago. And they did it, they worked with their auditors and they did it plant by plant around the world. So they had some plants were on standard costing, and that was because they weren't that far in the lean journey and they still had a lot of inventory, where other plants were quite lean, didn't have much inventory, and they could use a lean inventory valuation methodology. So it is possible to make this work. And like I said earlier, it's about having a plan and a vision and then following through with that. So let's look at the different methods to capitalize production costs. One method is using days of inventory. And what you're doing here is figuring out how to get the average. So we're going to look at the number of days of inventory to get a ratio so that we can determine what level of production cost to capitalize. We can also do it by units of inventory. So we have so many units of finished goods, raw material, and WIP, and then we can calculate the average production costs to capitalize in that manner. We can also do it through days of conversion cost. And a final method is historical margins, which basically means let's maintain our historical margins that existed even when we were in a standard costing methodology, and we can recalculate these annually based on how much improvements that are made. As I said earlier, companies have used all of these methods, and they have been certified by their auditors and tested. So what I'd like to do now is show you some examples. So here we have a simple value stream income statement. You can see the numbers here. We have a beginning inventory of 1.186 million. We have 20 working days in the month. We have total material cost of a little over $849,500. And we have total conversion costs of $876,550, which is, if you sum the numbers up in the value stream income statement, that's the total that you get. So what you do is you calculate cost per day. We have 20 days in the month, so the material cost per day is $42,476. The conversion cost per day is $43,828. And then you look at how many days of inventory do you have in each category: raw material, WIP, finished goods. And you can calculate the material value, you calculate the conversion value, add the two numbers up, and you get to $963,000 of inventory, and that creates an adjustment of almost $223,000. Now, work in process, you have to make an assumption of percentage complete, and in this case, I think it was about 50%. Finished goods obviously is 100% complete. Material is 0%. Material does not have any conversion value attached. So this is one method. Again, pretty simple. It's consistent. It's repeatable, and it's easily tested by auditors. Another method is based on units. So here we have the same value stream income statement, same costs that we're trying to capitalize. We have 22,861 units manufactured. So we can get a cost per unit for material of $37.16, conversion cost per unit of $38.24, and then it's simply doing the math, knowing what the quantity is of raw materials, work in process finished goods. You can see we get to the 963,000. Same. We get to the same value of inventory, just using a different ratio. Now this method, the number of units and the days of inventory, you can use that for material and conversion costs, or if you wanted to, you can use it just for conversion costs, which is this method right here. And like I said earlier, if you keep your material in your ERP system, it's just about capitalizing the conversion costs. So in this case, we're going to look at days of conversion costs. So we have material value of $474,036 on 20 days of inventory. And so that's 11.16 days of inventory. So what we're going to do is we're going to use the ratio of 11.16 divided by 20 days to figure out how much of the $876,550 needs to be capitalized, which comes to $489,115. And again, we make the necessary adjustment using a simple journal entry. So those are three methods in which you calculate an average cost. And historical margin, this is a method I used one time at a company where the auditors were they wanted consistency in the gross margin. And so we came up with this methodology. I'm going to review it. This is actually what the company did. And here are the steps. One is to calculate the labor and overhead as a percentage of material cost at standard. Second, to begin the process either at fiscal year end or whenever you decide to do this, it's typically at fiscal year end or a month end, you set your labor and overhead rates to 0. So the system, no production is going on. And you're just working this out without any activity in the system. Third, you let the system, your ERP system, revalue your inventory. What you'll see is that it's just going to be material cost because the labor and overhead rates are 0. Then recapitalize the production costs. So the difference between the original inventory, which had labor and overhead in it, and the revalued inventory, you just put that back on the balance sheet because it's been sent over to cost of goods sold. Then you open up your new accounting period, you start your manufacturing period in your ERP system, and what you're doing is you're just running normally. Inventory is just, everything in inventory is just material. And quite frankly, a lot of operating people like this because they understand material. They get very confused with labor and overhead rates and why is product A more than product B because of the application of overhead and all that. And then finally, at every month end, what you do is you calculate the change in your capitalized production costs. So let me show you an example, and I'm going to go really, I'm going to show what anybody in accounting is going to understand. Some of you non-accountants might not understand, or something we use in accounting called T accounts. So step one is to calculate labor and overhead as a percentage of material cost. So you can see that this company has 4 value streams, and the labor and overhead as a percentage of material cost is quite different in each of the 4 value streams. So because there was a significant difference in the labor and the overhead rate, labor and overhead as a percentage of material cost, what we decided is we were going to calculate, we're going to use these, we're going to look at it value stream by value stream rather than just using a simple 62%. So we calculated that. Then step 2, again, it was at year end, and we set the labor and overhead rates to 0, and we revalued inventory. And what the system did is it credited inventory $556,754, and it debited cost of goods sold. So now on your balance sheet, the inventory account is just material. So now in step 3, what we have to do is we have to put it back. Step 3 and 4. So again, that's just a simple journal entry, and it's done in a different balance sheet account, which we happen to call capitalized production costs, because we're going to be doing this on a monthly basis. And what we wanted to do was we wanted to separate the inventory account, which the system is using, from the capitalized production costs. We wanted to keep inventory at material only. So that's what you do at year end. So then in the month of January, we had our ending material inventory, which you can see totals $997,514. That's the second line from the top. And it's broken out by value stream. And you simply take the ending material inventory, you multiply it by the labor and overhead as a percentage of material cost, and you get what your capitalized production costs need to be at the end of January, which is $572,529. The beginning costs are $556,754 from December 31st. So you simply have a debit to capitalized production costs of $15,775 and a credit to cost of goods sold for the same amount at the end of the month. And you have now capitalized your inventory. And you just continue to repeat this every month. And this is the historical method that works quite well. So that wraps up the examples. And what I'd like to do now is spend a little time summarizing everything for you. First, the journey to lean inventory valuation, or you could call it the transformation. It's really a matter of maintaining GAAP compliance and going through a lean accounting transformation. So early stage lean, when you're just getting started, to maintain GAAP compliance, continue to use the current method that you use to value inventory. Whatever that may be, just continue to use it. Don't worry about changing it just yet. Develop your value stream income statements, which you're using for internal use. Mid-stage lean. Now, some of you may be asking, what is mid-stage lean? Well, are you starting to achieve a level of inventory reduction? Are your performance measures improving? Are lean practices, methods, and tools deployed throughout operations? Begin to simplify your current methods. And what I mean by that is, let's say you're using a product costing system with labor rates and overhead rates. Reduce the number of labor rates. Reduce the number of overhead rates. That's simplification. It's probably not going to matter that much when you get to total inventory value. And this is something I did before we actually became a lean company. I worked with the IT people and I worked with manufacturing people, and we simplified our standard costing system because, quite frankly, we didn't like it. It created a lot of complexity and work, and so we just simplified it. And we went from, I forgot how many rates, but we went down to like 1 or 2 labor rates and maybe 1 overall overhead rate. Continue to deploy and use the value stream income statement for internal use and analysis. Then when you achieve and when you get close to the 30 or 60 day mark in terms of days of inventory, this is where you can formally move to a lean inventory valuation methodology using the value stream income statement to gather your actual costs, and then you can use one of the methods to determine what the average cost is. And at the same time, because you have less inventory, the value stream income statement happens to also serve as a good foundation for your external reporting because you don't have much inventory. So that's sort of the general journey, and every company is a little bit different. Now here's a little bit of a reality check. in regards to standard costing and a lean strategy. First, the information that standard costing provides in terms of variances and absorption in, ter- in terms of using that information to measure operating performance, it's just totally incompatible. Lean operational people don't like that information. They know it doesn't give them what they need to know. And so it's very important to understand that, this is really what the lean operational people, this is what their big complaint is. I don't want that information. Secondly, it is inevitable that if you are a manufacturing company and you have a lean strategy, that you will have to face this issue, measuring operating performance and eliminating those variances in absorption if you're currently using standard costing. It will happen. It might not happen today, but it will happen. You also have to face the issue of inventory valuation at some point. I think it's important to separate the lean management accounting system from the inventory valuation methodology. And that's really what standard costing does. The standard costing information provides uh, a lot of operating performance information, and it also does inventory valuation. And because variances and absorption they get posted on the income statement, it becomes a financial reporting issue. So let's try to separate those. So you have a management accounting system that is used by the management of the company to run the business. And then you have an inventory valuation methodology, which is used in accounting to simply value inventory. And finally, lean practices in financial accounting. As I stated a few minutes ago, the opportunity to eliminate a great deal of non-value-added activities in regards exist when you can go to a lean inventory valuation methodology, and you can capitalize your production costs at a macro level rather than a micro level. What gets eliminated? Setting rates at the beginning of the year, analyzing variances. Think about all the effort and in terms of answering questions, resolving issues. Why was this variance X this month? And digging into the details. I remember this from my early days as a CFO. I mean, I never liked the work. And back in the day in the 1990s, before we embarked on lean inventory evaluation methods, I actually had a cost accountant, and he used to run all these big reports and dig into every single work order to see where these variances were. And all that work goes away. Now, what do you do in accounting? Because you have these people who are very good analytical people. Well, you move them into lean accounting type activities. So there's plenty of work to do when the standard costing work doesn't exist anymore. So here's some practical advice. You must design a lean inventory valuation methodology which works for your company. The key, which I've stated a few times and I want to state again, is the capitalization of production costs. Do a macro valuation method rather than product by product. This is the key to making things a lot easier. For material value, my recommendation is keep it in your ERP system with average actual cost, unless you have few parts. Just don't even deal with it. And finally, get your auditor buy-in. Partner with them to create a methodology that they can test. This is what I did. I talked to our auditors. I said, I want to create a simple method. I had some ideas. What we did is we created a method. We tested it. The auditors looked at whether they it was consistent, whether they could test it during the annual audit. We settled on a method, and then that's what we used from there on out. It's important to think like a lean accountant. What do I mean by that? We need to maintain GAAP compliance in the leanest way possible. That's no different than in a lean production operations, where you want to maintain quality standards in the leanest way possible. Don't take your sight off the goal. What's the simplest, leanest way to capitalize actual production costs for your company? That really is the definition of turning off standard costing or eliminating standard costing. That's the way I look at it. Apply the principle of continuous improvement. Simplify your current inventory valuation systems when inventories are high. Eliminate as much non-value added work as possible, because all of the work is non-value added. And then set your future state. What is the methodology you want to use? Work towards achieving that goal. Have a long-term plan. You can base that long-term plan on days of inventory. Lean operational people and an overall lean strategy, usually they have a measure of inventory like days of inventory, and they say we want to improve days of inventory by X% a year. Well, you can measure that and say and figure out in approximately how many years will the company get to 30 to 60 days of inventory. And remember, focus on customer value. External reporting value is GAAP compliance to the readers of your financial statements. Internal reporting, it's about usable financial information for operational people. So we had some learning objectives at the beginning, which I'd like to review. First learning objective is that generally accepted accounting principles requires companies to use cost flow assumptions to value inventory, because costs continually change in manufacturing. Lean inventory valuation methods comply with GAAP by using average cost, but they value much less inventory because lean reduces inventories over time. Third, capitalize your production costs using a macro approach rather than product by product valuation. In general, material value is valued product by product using average cost of last price paid. And fourth, lean manufacturings will have to face inevitable discussions regarding the incompatibility of standard costing, performance information, and lean practices. Have that discussion. If you're in finance, lead that discussion. And less inventory creates an opportunity to simplify valuation and eliminate non-value added work. Again, that is another discussion. These are strategic discussions that don't reside just in finance, but are cross-functional. I remember having these discussions, and I think they really, really work. So that wraps up the presentation. And if you want to learn more, you can go to our website. We have blogs, articles. You can get links to buy books. There's a link to all recorded webinars in 2018 and 2019. You simply register on the website, you get that link, and these recorded webinars, excuse me, the link never expires. You can also sign up for our newsletter, where there'll be new blogs, new webinars, etc. If you have any questions, please feel free to contact me at any time. There's my email address. And we have a LinkedIn group, the BMA Lean Accounting. Please join it and participate in the discussion. So we have a little time left. I'm going to open up my pane and see if there are any questions. And I actually don't see any questions. Maurice wanted to provide us with the results of sheets 18 to 20. Maurice, send me an email on that because I'm not sure exactly what you mean, and I'll be glad to try to answer it outside. So I'd like to thank you for this webinar. Look forward to doing one again next month on another topic. And again, if you have any questions, please contact me. You will be receiving, if you attended the webinar live, you will be receiving a link, an email tomorrow, a follow-up email with a link to the recording. And you can share that link with anyone you want inside or outside your company. And if you did not attend the webinar, you will have already received this link to view it again. Thank you very much and look forward to seeing you again. Bye-bye.